Welcome back to Crypto Risk Office Spotlight. In this series of interviews, we are dedicated to investigate and, more importantly, to raise awareness about risk management and compliance best practices within the crypto ecosystem. Join us as we navigate the intricate landscape of this dynamic industry and shine a spotlight on strategies that can empower you to operate within it with greater safety and confidence. Disclaimer, what is discussed in this podcast is not meant to be, nor has to be considered financial advice. Featured guest today is Francesco Mochi Sismondi, co-founder of Not Your Money and author of the Crypto Valley Association research journal on risk management standards for crypto asset class provider. Francesco has 20 plus years career, has career as a risk management executive at Morgan Stanley and HSBC. More recently, he was an advisor to the Bank for International Settlements, BIS, and developed the risk function and capabilities at Swissborg, a Swiss crypto asset service provider. So without any further ado, let me introduce Francesco. Ciao, Francesco. Welcome.
Hi, Alessia. Pleasure to be here.
Thank you for being here with us today. I'm really happy because you're the first Italian on the Crypto Risk Office podcast, and it's nice to have another Italian representative on the podcast.
Hopefully, many more to come.
Yes. But for the sake of, the audience and general understanding, we're going to speak English today. So, Francesco, I would say, let's start talking about you. I gave a little introduction about yourself, but I would like to hear more. If you can share with our audience your background and also like what brought you to approach and to move into the crypto space.
Sure. I come from a rather traditional banking and financial industry background. I finished my studies in economics and business. I stepped into banking, the private banking side of Morgan Stanley, and spent a good part of 13, 14 years in the UK, and then moved to Switzerland with my family, where I continued pursuing my banking career as a risk manager, specifically as an enterprise and operational risk manager. Subsequently at HSBC, I did some consulting at the Bank for International Settlements, but I could feel something within me that wasn't quite fulfilled. I could sense the world was progressing and digitalizing and adopting technologies in so many different ways that I wasn't seeing within my own day-to-day practice. I wasn't seeing develop within the industry I was within. I took a step out deliberately to learn, effectively, to pull my sleeves up, understand what technology was out there, started a bit of a haphazard entrepreneurial journey, and then found myself setting up shop at Swissborg, as you mentioned, setting up the risk capabilities at that crypto startup. We know the crypto industry has been very volatile, so I'm no longer part of that journey, but I'm still a huge believer of the blockchain and the crypto movement. I'm a big believer of Bitcoin and what I think it brings to the world. And I think what we've just seen overnight with the legitimization from the SEC is a statement in that direction. I feel I was definitely right in pursuing my vocation.
Yeah, and absolutely. And we all were approaching the space and believing in the space, and what happened last night is definitely a great signal that things are going the right way. So going a bit deeper into our conversation, we're going to talk about crypto risk standards today, forging a secure path forward. This is the topic of our conversation, and we're going to analyze and discuss with you what are the key findings that you discuss in your in the Crypto Valley Association research journal on risk management standards for crypto asset class provider. So my first question is about giving some introduction and context. So if you can provide more context on the current state of the crypto and Web3 industry and the impetus behind the push for a risk management standard for crypto asset service providers?
Sure. Let me provide a bit of a helicopter view, at least the way I look at it. We're 15 years into this industry, from the birth of Bitcoin to where we're at today. We're still in the teenage years, right? So from the earlier geeks and tech cyberpunks working at blockchains and passing and buying pizzas for 10,000 Bitcoin and whatnot, we've seen extraordinary growth in the industry. So kudos to what this industry has been able to deliver and innovate. At the same time, the industry, as often happens in a novel industry, has had a free lunch in terms of lack of moral compass, if you like, or clear background regulatory guidelines to operate in the right manner. Tech innovation can come in all sorts of different forms, but the way I often relate within my own sort of interactions, this isn't about the next Uber or Netflix. This is about managing money. At large, the crypto and Web3 industry is about managing assets, financial assets, and as such, we could not expect failures to not come about. We've seen plenty of them over the last crypto winter, from Terra Luna, FTX, Celsius, Voyager. The list is humongous, and the market's paid its consequences. I believe this has been really healthy for the industry. It's given the industry the opportunity to remove itself from the spotlight, get back into building, which is probably what it likes to do best, and start building some of that maturity to face off the next wave, the next institutional wave, as we've seen again through the ETF sort of blessing, is now at the door in footsteps, with potentially trillions of dollars flowing into this ecosystem. So I'm cautiously optimistic. I think there's fantastic momentum that's building back again, but we also need the right innovation. We need the right momentum, and we need the right balance. We need a rebalance, in fact, from the sort of go, build, develop, innovate, break, to a slightly more conscious, organized, well-governed growth.
Absolutely. And so you manage what were industry challenges and the crash of a few companies. So digging a bit more in what are the industry challenges, how do you challenges like opaque projects and scam impact the growth and credibility of the crypto industry, and why it is essential to address them now?
Well, what is the impact? The impact is gigantic, and we've seen the market's effect, if you like, right? From an over $3 trillion market, we've seen 60 to 70% of that being obliterated almost overnight. So I think that proves it right there. We cannot continue seeing these types of repercussions manifest themselves if we really are true about scaling this industry. Whilst on the one hand, projects are in recovery and build mode, at the same time, we're seeing regulators at the door. In Europe, MiCA is a great example of how the jurisdictional landscape has set out stall and shop, if you like, and the same has happened in many other jurisdictions. To start setting out a comprehensive framework, a level playing field where all actors and market participants, and hence CASPs, which I think are vital in this ecosystem, at least at this point in the sort of crypto and Web3 industry journey, in helping them play in the same playing field, understand how to classify assets, how to operate in a well-regulated way, insofar as so many different aspects, from money laundering to security aspects and so on. So I think this all together will help keep at bay more of the opaque projects. I think we're going to see more consolidation. Let's face it as well, the crypto industry to date has been a startup industry. I don't mean it in a derogative way. It's just a reality. Every one of the companies from Crypto One actually made. Let's put Bitcoin to one side. That's not really a startup. Let's consider that a decentralized asset in its own way. But for all other tokens, at peak, I think we had over 20,000 crypto tokens in the crypto marketplace, at least according to CoinMarketCap, Messari, and the likes. They're all startups, and that means they're struggling in their own way for product market fit, for cash flow, financials, security, and all of them are destined to have hiccups in one way or another. In typical sort of venture capitalist way of framing startup dynamics, typically 95% of them fail. And whilst I don't deliberately wish that to the crypto industry,
let's hope not.
I don't think the crypto industry is about proliferation and endless blockchains and scaling solutions. I think we need to be really focused about use cases and what really matters and what really brings value. And if that comes with a bit of consolidation, if that comes with a few further broken plates, I think we need fewer but more scalable, solid solutions for the future. It's not a race about having millions of crypto companies out there. I don't personally see what value that would bring to our world.
Yeah. Absolutely. Indeed, my next question would have been about building solid foundation. And I think in part you already answered, but maybe we can go deeper into that. And what are the key learnings from the latest crypto winter? And how can these lessons contribute to creating a more stable and mature ecosystem for the crypto and Web3 industry?
To be perfectly blunt, although I don't like to paint sort of the whole industry with the same brush, but what we've really seen is, in particular since the 2017 ICO craze, when any entrepreneur could literally issue a token off the back of a 2-page deck with no code written and raise millions. I think we can learn from that a hell of a lot. So we can start parking away some of those greed, get rich soon schemes, which I think both retail investors, institutional investors at the door, and regulators will be able to sort of keep at bay. Governance failures have been plenty. Whilst we keep hearing from sort of the market participants that they're very focused on risk, I typically consider risk focus in the crypto community this far to have been primarily focused on technology security and compliance to a degree. That has typically been forced upon them just to obtain the licenses in the various jurisdictions. But I think of risk in a far broader sense of having a real moral compass at the top level, at the C level, from executives to every member of any enterprise operating in this space. Really need to start thinking about prioritizing risk as much as is important to keep growing and innovating and of course seeking profits.
Yeah. So I would move on about talking to in institutional scrutiny. It's mentioned in the report that you co-author that to thrive, the crypto industry needs to withstand the institutional grade scrutiny. How can setting clear market standards and rigorous practices help gain the trust of institutional players?
Well, again, we've seen it just happen, right? So if we think of the early days, we had the crypto geeks, retail investors participating in this ecosystem. Some corporates were able to go in, proprietary corporates, maybe hedge funds were able to sort of sniff the opportunity and take a punt. Large financial institutions willing to participate in this space have not been able to. Even those that have started shifting their mindsets and embracing and understanding the value simply could not afford the gamble. They didn't know what regulatory environment they were operating within. They couldn't see through the project. They couldn't really understand and grasp the value, the technology, the teams behind the projects. also due to some of those problems I raised earlier around lack of transparency in governance, in risk management standards and protocols, and large financial institutions. We've seen the VanEcks, the BlackRocks. They're not just going to take a punt in an unregulated way without understanding what they're really getting into.
Yeah.
So if you think of it from maybe the world that I come from an institutional perspective, investing and really going long in a new ecosystem, in a new market, requires layers and layers of, let's call it red tape. At the highest level, perhaps just a pure regulatory, jurisdictional needs and requirements. You're not going to cross that line. Internally, you also have internal risk appetite policies and mindsets that need to shift before we can really embrace that interest and go in with full conviction. So I think with all of that, institutions have a far greater, let's call it due diligence scrutiny around investments. They won't just go in lightheartedly and take a punt, as I said. That means all projects, I call them projects, but every crypto project, let's even face some of the largest out there in the marketplace. Take Solana as an example. It is still a building ecosystem. If Solana was to be considered by a bank, a financial institution, well, then they will need to be subject to a hell of a lot of questions and scrutiny before they can convince themselves and really persuade themselves to take that bit of risk and take that calculated risk to make it worthwhile. So
Absolutely.
all projects are really warned, right? The crypto industry is now under the spotlight again, deservedly so, but it has to stand up to the level of maturity that is expected at this point in the journey.
Yeah, no, definitely. And then can you elaborate on the critical role of crypto asset service provider in maintaining high standards and safeguarding the crypto markets? And why are they considered crucial entities in this ecosystem?
Well, if we keep the native techies to one side, if you like, which are the 0.0001% of global investors maybe operating nodes and being able to transact in the crypto community on a truly sovereign basis, everyone else on the streets, from retail to institutions, will need market participants, market operators, intermediaries to access this market, whether it's to buy and sell these assets, to custody them. All of these are in one way or another centralized market players. So let's call that, in a wide vacuum, the crypto asset service provider space. They serve this sort of critical intermediary role in serving the entire market. I think that this far they've been given a free lunch to operate in a very lightly regulated way. From here on, I don't think they can afford to operate that way anymore. Will that be the case? I think the regulators are quite clear in many jurisdictions. I mentioned MiCA in Europe. There will be some arbitrage, no doubt, for some players that will want to continue operating in, let me just say, slightly less legitimate jurisdictions and play that arbitrage. But I think retail investors, and certainly the institutional ones, are becoming smarter. I'm speaking for the retail ones, but the institutional ones are already well prepared to be able to sniff around largest opportunities and expect to have the highest rigor and standards. Take all of these huge asset managers going into the ETF space. They're all relying on Coinbase, for instance, as a custodian to their assets. Well, Coinbase happens to be maybe the pioneer in terms of it's the first crypto company that has come of age and become a truly regulated, listed company on an exchange. But I think we should start expecting to see more of that standard. And to a degree, actually, if we look at what's recently happened to Binance and the US monitor expected on them to really clean their old house, being the largest exchange in the market, I think we can bet that all regulators will be watching at how that plays out. And all crypto companies will need to start looking at Binance as a standard. Perhaps not right now, but as it comes through this journey as it cleans up and will have to implement best of class frameworks and standards around compliance, legal risk, etc. I think we'll see greater responsibility raised and being expected as part of as each of the CASPs in the market.
Yeah, absolutely. And then, so what do you think is the rationale behind focusing on centralized players in the market? And how can the recommendation be adapted for the evolving space of decentralized finance, DeFi?
Great question. Well, for starters, we focused our paper on the centralized players because they're simply the lion's share of the market. I think at peak, the DeFi space had 200 million of assets locked in DeFi, where the market peaked at 3 trillion. That means, roughly speaking, that the decentralized finance world represented no more than 7% of the market. So let's fix the biggest part of the market first, and then figure out how to manage the rest. I'll be honest, I'm not a technologist, and I think we all need to learn a hell of a lot more about the capabilities of the truly decentralized financial markets, peer-to-peer, borrowing, lending, yielding, earning, farming through smart contracts. Now, can our observations and recommendations apply? Can some of these best standards apply to the DeFi space? I have every reason to believe that is possible. I do know there is an Oracle problem right now. So if we think of it, the decentralized financial world is through smart contracts. And I may be criticized for what I'm about to say, but I don't necessarily think of them as truly smart contracts. They are just self-executing contracts. They're not necessarily smart in having a conscious and knowing what the right and wrong thing to do is. They just execute the code that they're written to execute. Oracles are those bridges that bring real life, if you like, whether it's laws, regulations, compliance, risk, security, into that technology. And those bridges are the pieces I think will need to mature. We don't hear of oracles that much at this point in time, but I think that's where we're going to need to grow and foster, build out those capabilities to be able to automate risk, automate compliance, automate regulation, and allow smart contracts to do what they need to do. So I think it's still very early days, but why not? Why shouldn't they be applicable to the DeFi space?
Yeah, no, absolutely. I hear what you're saying, and I believe more and more technologies will come up, and more solution will be delivered in this sense. So it's definitely a space to watch very closely. Diving into the key areas for improvement in CASP practices, how do a clearer classification of tokens, due diligence in listing, and dynamic risk assessment contribute to a healthier crypto market?
I feel tempted to ask you the question, Alessia, as to what was it like for you when you started delving into crypto and just trying to get your head around what's a smart contract, what's a stable coin, what's a layer 1, what's a layer 2, what's a payment token, what's a utility token, and so on. It takes time to start.
It takes time. Yeah, education is key in that sense, right? You need to take time to understand all the products. Yeah,
precisely. And if you just jump on any of the major market data providers, be it Masadi, CoinMarketCap, CoinGecko, you'll just try this after the call. Try looking at how they're all representing classifications of cryptos. You'll see that everyone has its own framing, its own approach. There's no consistency and consensus around what's one type of token versus the other. Put it very bluntly, I'm looking at the crypto marketplace a little bit like a primitive caveman would look at the financial industry. Cash, FX, equity, bonds, you name it. They're all financial assets. I think we need to start getting a little more granular and help the industry evolve and understand what is what. what is a stable coin, how does it work, and even within those classes make clear distinctions between peg stable classes, algorithmic stable classes, what are utility tokens, payment tokens, layer ones, layer twos. I think we need real firm guidelines and standards around this and help consumers invest with confidence. You need to be able to get to a point where any given investor can start understanding how to break down the market, potentially build a portfolio if that's what they're looking to do, and understand how to select the right tokens from the relevant parts of the market. Right now, for some people, investing in DAI or USDT or Terra Luna or Dogecoin, not to mention Bonk, the latest meme coin on the street, they're all compared, on price. They're all, I think they're just blended into this macro universe without clear distinction. So we need a clear taxonomy. I think that's pretty obvious, and to a degree, the regulators are helping. Only in part, it's my personal opinion. In now knowing we need to, can start making some clear demarcation between security tokens, utility tokens, asset tokens, payment tokens, and so on. But I think the classification is far richer and deeper than that, and requires some market coordination amongst participants to come out with appropriate standards. I don't think we can continue expecting regulators to spoon feed the industry with the right tools. I think I like the example of the airline industry. The airline industry self-evolves and enriches itself. After every market crash, the black box sort of analysis is open source. It's shared so that every other company can learn from those mistakes. I think the market needs to start coordinating itself and participating in a sort of more self-regulating mode than it has been this far. Essentially, there are 4 recommendations. We spoke about the first one in enabling and providing a clear taxonomy that can be adopted for the industry. But acting as the market guardians, CASPs have to go further than that. They ultimately have to stand up to their fiduciary role within the market. And I see 3 extra things. One is a more rigorous due diligence approach. What I mean by that is the selection of projects to be able to list them. Right now, let's be honest, a lot of that has happened through FOMO, through volumes, through profit-seeking motives. We list a dog-faced meme coin, for instance, just for the sake of it, without necessarily thinking about what it really means, what its underlying utility may be. I'm not going to judge whether that's right or wrong, but I do think we need a far more rigorous approach towards listing new assets. And that has to be comprehensive and a standard process. For instance, covering qualitative and quantitative aspects. Who are the founders? What's the team? What's the budget? What's the project? What's the roadmap looking like? What's the funding? Is there any audit? What's the security, licensing, regulation, compliance? There's a lot that should be known and uncovered up front before listing a token, but also on an ongoing basis. This has to be dynamic. It doesn't stop there. Negative news can come about at any point in time, and CASP, I think, have that obligation. They have to own that obligation of maintaining that standard over there, of the supply side of the market, of those projects that are trying to find buyers, if you like, in the market. Once we have the classification and the clear due diligence, I think we also need rigorous risk assessment. We need to be able to assess and provide consumers with a clear understanding as to how different assets, how different crypto assets compare to one another, what their risk profile may look like, and on what basis. That way, we can start also conceiving what in the traditional world may be considered suitability, customer protection type of scrutiny around matching the risk profile of a user and the risk profile of the assets. Intermediaries should be discouraged. I know typically market players and CAS like to operate in what they call execution-only basis. It's an unsolicited industry. The reality is vast amount of marketing, FOMO, plays communication, leads consumers to jump in and invest. I think we need sort of those layers of risk lenses and warnings to help consumers really understand if I'm going to buy this asset because I'm promised a certain yield of 5, 7, 12, 20%. What's the other side of it? What's the risk I'm taking? That allows me to make a fully educated, conscious investment decision. That assessment also has to be a dynamic one. And last but not least, just transparent investor disclosure education. Investors have to be informed. This isn't just a marketplace free for all. It's not a casino. It's a new financial market. It's largely unknown to most, from wallets to exchanges to the fee elements to the crypto assets themselves. All of this needs to be carefully understood, and it impinges on the CASPs themselves to perform that education, to make sure they understand their clients, to make sure they understand what clients are looking for, and if certain assets are or are not appropriate for them. Just take an obvious 80-year-old unsophisticated investor putting a large part of their net wealth in Dogecoin. I don't personally think it's honest and appropriate for that to continue happening without appropriate safeguards in place. I hope I made my point clear. We just need CASPs to start fulfilling the true fiduciary responsibilities, and I think we're going to be in a far better place.
So looking at the future evolution and compliance, how can regulatory compliance, market integrity, and consumer protection be integrated programmatically into the core proposition and building blocks of DeFi project, considering the evolving nature of the space?
Again, this goes back to the earlier question. So if we start with a centralized finance, if we could just park DeFi to one side for a second and address the bigger part of the market, I think we are already able to look at some fantastic evolutions in, for instance, financial crime monitoring and surveillance. Transaction monitoring tools such as Chainalysis and Elliptic are formidable in enabling firms, market participants, and potentially regulators, if necessary, to understand the flows of assets, where they're coming from, where they're going to, and if anything, they are far from, these tools are able to demonstrate that this industry is far from the money laundering honeypot that lots of outsiders like to frame this industry as. Far from that. So I'm optimistic that a lot of the same sort of technology can be deployed in similar ways across other risk spectrums. With evolution of technology, AI, machine learning, there's so much that can be deployed, already is being deployed. In fact, at my prior shop at Swissborg, we were using machine learning to fight scams and fraud, and we're able to build solutions to massively reduce the amount of attempts. And that just goes ways around showing how technology can use information in a digital world, whether it's geolocalization, patterns, user patterns, transactional patterns, and put them together to bring risk at the heart of the game as well. We don't just need data per se to arbitrage and make profits. We can use data and technology to protect the market and the industry as well. So I think there's already plenty happening in the centralized space. As I mentioned earlier, if we can get the oracles right, we can translate some of that thinking and technology and build the bridges into the DeFi space too. I think it's still very early, to be perfectly frank, to express a decisive opinion on DeFi. The jury's not out, and my mind's not set entirely around how this is going to work in a truly decentralized way. For starters, we need to see whether that promise of a generally decentralized market will ever really materialize.
Yeah, well, thanks for sharing your point of view. It's definitely really, really interesting and gives a lot to think on. When it comes to, balancing innovation and investor protection, so stressing the importance of not compromising investor security for innovation, How can the crypto industry strike a balance between fostering innovation and ensuring investor safety?
I think I might have covered this or touched this in part without sort of, first of all, let's not undermine the immense amount of innovation that's already been achieved. In my opinion, even if we were to turn the lights off or just pause the industry, what's already been achieved, even just with a Bitcoin announcement from zero to a Bitcoin ETF in 15 years, is probably nothing short than the most incredible innovation the financial industry has ever seen on technological blockchain rails. That said, I think we do need to, my wish is that we'll see a little more, if I may, boredom in the market, a little more patience in not just pushing out product innovation at infinite speed, but instilling a more cautious way of innovating. I think we've seen the building blocks come about. We now need to rebalance and reshift priorities from the very top level in organizations, in the market players, in those CASPs I mentioned, from profit seeking to safeguarding the marketplace. Profits are short-lived. Just look at what happened to FTX. If that's the sort of example to go by, I think we would all wish to move slightly slower, but in a cautious, secure, resilient way for what I expect to be incredible momentum in the years to come. So we need to build that scalability and robustness and maturity in the market.
Absolutely. And so here comes my last question. You partially answered already, but to wrap up the whole conversation, I would ask you, looking at the adoption of new standards, what potential obstacles or challenges do you foresee in getting CASPs to implement and adhere to proposed risk management standards?
So I think entrepreneurs in the space, as I said, have been able to move at pace and have their free lunch, so to speak, in an unregulated way. Most of them have. So it's not going to come without pain. Nobody likes to be told what to do, and certainly, tech entrepreneurs don't like to be told from older fellows in centralized regulatory regimes, what's good and bad. That said, we've seen what negative outcomes can come about, and I think that there won't really be much choice not to comply. So whilst there will be some resistance, I don't think there'll be much of an option. The regulators are coming in, there'll be greater supervision, it'll be harder to get licenses, there'll be less new projects coming to market. I don't think we're going to see an ICO craze again. So we'll see a more composed entry to the market. And for those market participants that are there, well, I have no doubt that some will play arbitrage games in seeking to maintain market share or build out under the radar. But it will come with consequences. So as I also mentioned, I do feel Binance is inevitably, whether we like it or not, set the standard in the market, and many CASPs and market participants will have to, in one way or another, follow that journey. I think regulators will be looking at that example and expecting and hoping not to see those same repercussions in their own markets. So very much hoping to see, robuster players, mature players operate in this market for time to come.
Absolutely, Francesco. That is also, my wish, and I think everyone wish. Let's say that this 2024 has started in the right way, I would say, and it's looking brighter than 2023 for sure. So I'm really excited for what is to come, and it's going to be a great journey, really.
It's certainly an exciting time. In fact, it's an incredible time to be alive and to be looking at this market. So yeah, touch wood. I wish everyone a great start to the new year and a safe start to the new year as well. Let's not throw away all the health and goodness that has been accumulated the last year or two since the last peak in really solidifying security, conviction, risk management at the heart and the foundations of this industry.
Absolutely, absolutely. Thank you very much, Francesco, for your time today, and it was a great conversation, and looking forward for more in the future.
Thank you, Alessia. It's been a pleasure.
Well, I'll see you at the next episode, and thank you very much to all our listeners. Bye. Bye-bye.